Hi, I'm Michael Glennon from Glennon Capital. Today I'm going to do a small video on volatility in the market. There's been quite a lot of volatility lately, and what that tends to do is it means that a lot of investors start to panic a little bit, which further enhances the volatility in the market as good companies are sold off and often present value. So I like volatility in the market. It's something that I can keep an eye on. I like the volatility because I understand the businesses that I'm buying. So we make sure that when we go out and we buy a business that we talk to the management, we've looked at the balance sheet, the cash flow statement, and the financials of the business. We've looked at the industry that the company operates in. So when there is volatility, it's like having a sale. It's like when you go down to Myer and everything's got 10% off. That's like that when the market's sold off. So we try and take advantage of the opportunity. We've got a list of companies that we like, that we monitor. And when the price gets to a level where we think that it's attractive to start buying that shares, we take advantage of the volatility in the market. So as an investor, you need to take a long-term view. If you like a company and you're thinking about buying it, and all of a sudden there's a bit of volatility in the market, or the market's reacting to an adverse event overseas and all companies are sold off, that's like this sort of 10% off sale at Myer. And that's when you really should be looking at that portfolio of companies that you're keeping an eye on, that you may not own, and going and starting to buy some of those businesses at prices that are reduced from where they'd normally be trading at. So a good example where we've taken advantage of volatility in the market is, we've liked Big Air. It's been a position of ours for a long period of time. It's now part of Superloop. However, when we first entered into that stock, the share price had started declining quite dramatically, as you can see on the share price chart here. And we bought, we did some inquiries. We found out that nothing had changed with the business. It had just really fallen out of favour with investors. There was not a lot of institutions that were on the register. And that's the joy of small caps. You can find good companies like this that are sold off. So we bought the shares, you started buying them in the mid-60s. And then there was a takeover for the stock by Superloop as the share price approached $1. And I think at the time the share price was $1.14 in equivalent Superloop stock. So a great return in a short period of time just by being active. Volatility is good, and you need to really think about it if there's nothing wrong with the underlying business. Share market volatility doesn't translate into volatility in the economy. The economy is generally pretty stable. It's growing at the rate of GDP, which say is around 3% per annum. So the market will gyrate by a lot more than 3% per annum. So when you're starting to see lots of volatility in the market and you've got a list of businesses that you own, if you've done enough work on that company, you really should be taking advantage of volatility as much as you can. And not just on the downside, volatility on the upside. If share prices spike very rapidly on the back of no information, that's when you really want to be selling your shares and maybe looking for something else that represents better value. Thanks for watching. That's how we view volatility, and I hope you can learn something from this video.